Hey guys, welcome back to the channel. Today we're talking about the stock market basics. This channel is all about helping beginner and experienced investors alike. So today we're going to talk about some stock market basics to help everybody out. If that sounds like something you're interested in, please smash that like button, consider subscribing to my channel, and I'll see you in there. So firstly, when talking about a stock market, we need to know what an actual stock market is. So this is a place, many countries have them, where you can trade funds and stocks in a company. For example, the SP 500 is one over in the United States, or the Nasdaq, very well known. Or over here in the UK, you've got the FTSE 100, FTSE 250, the UK stock exchanges. Of course, there's extra variants of that as well. These funds always go up and down. You can invest in companies in index funds that track the whole of the SP 500 and the FTSE 100 or FTSE 250. Now this is your most simplistic hands-off style of investing, and it will give you a solid consistent return over time without you having to do very much effort at all. The typical growth of the SP 500 as a whole is around 7% a year. So many investors use that as a benchmark to set their portfolio against, to see if they can beat the market, so to speak. So if their portfolio can earn more than 7% in a year, then they're ahead of where their money would have been had they just invested in an SP 500 ETF and saved themselves all the effort. If you do not have the time to commit to researching out stocks, then SP 500 or ETFs, index tracking funds, are the investment for you. You have to do very little apart from try and find one that has a low fee attached to it, and then you can just invest your money into it each month and almost guarantee yourself that 7% return each year. If you're more of an active style investor, then you can consider building yourself an actual portfolio. So what is a portfolio? Well, that is a collection of your stocks that you've invested just in yourself. So you have what's called a brokerage that you can set up with the likes of Freetrade or Trading 212. And once you're set up with them, that is your conduit to the stock exchange. When you purchase your stocks, they will be held in a portfolio on one of those accounts for you. Now you can build your portfolio in a couple of different ways and gear it towards whatever you want. So if you're aiming for dividend income, then you buy stocks that will give you dividend income. If you're aiming for growth, then you do that. Or you can do something in the middle. It's really down to you. As long as you research your stocks, which is the most vital thing, and buy high quality, great value companies, you can't really go too far wrong, as long as you have a portfolio of between 10 and 30 positions for diversity reasons. By having your own portfolio and picking your own individual stocks, you are hoping to try and beat that 7% benchmark set by the SP 500 index. Now, if you're looking for even more excitement, then you can look at getting involved in the day trading stock side of things, or investing over the short term and literally trading the news or trading catalysts or trading economic or political events against certain stocks. Now that carries a high degree of risk, and you need to dedicate an awful lot of time and research to get that right. Otherwise you will end up losing an awful lot of money. For safety reasons, it is better to go with, if that isn't for you, stick with your ETF investing or your normal portfolio building in value companies. Don't go after the trading side of things, because that is where the highest amount of risk is, and we want to avoid that, and we want to avoid you losing hard-earned money. A few terms that you might have heard when mentioning the stock market is a bull or a bear market. Now a bull market is when the market is on the up, and a bear market is when the market is on its way down. Typically 20% or more down, it indicates a bear market. Now the one thing that can be guaranteed in investing is that there will be bear markets, there will be bull markets. Usually bull markets last a lot longer than bear markets, but make no mistake about it, if you're in a bull market, there is definitely a bear market coming. Now bear markets usually offer the best buying opportunities, especially when you're buying value companies. Now if a company that you're looking into is significantly down, then firstly you need to ask yourself why, but then if it checks out, then it definitely presents a buying opportunity. And this leads nicely onto what is a stock market crash and what is a stock market correction. So a stock market correction is a 10% dip in the market, where the market is sort of equalising itself out and establishing its new feed and its new foundation. A stock market crash is anything when the market falls more than 10% in a steep period. Now this could be just the matter of a couple of hours in some severe instances, like way back in the global pandemic in 2020. The market sold off very quickly as investors literally pulled out. Now anybody that stuck around a bit like myself found themselves some fantastic buy opportunities then. If you do your research, you have to do your research because you need to know why the company has plummeted. But if the whole market is down by 20 or 30%, then you can bet that the company hasn't done anything fundamentally wrong. It is rather a whole market reaction to what is going on a macro scale. If there is a stock market crash or a stock market correction, please, I implore you not to panic sell. Panic selling is where you are going to lose money, and I get it. People see red and they start seeing double-digit red where their stock is down 10%, 20%, 30%. But as Warren Buffett says, if you're not prepared to see your investment in a company go down by 50% and still hold, then you really shouldn't be invested in the company. And your research should suggest that you can hold that company through thick and thin. And that is what tends to happen in a stock market crash. Your actual stock goes down towards fair value, or even more into fair value, where all the pump of extra people's money has been ripped out of it, but the business fundamentals are still the same. So that means that you can buy in at a much lower price. Numerous millionaires have been created by buying great companies in the middle of a stock market crash, because as I said, all the money's been ripped out of the company. You are literally just buying fair value. That leads me nicely on to prices do go up, prices do go down. That happens and they fluctuate daily, affected by a whole host of things: media, politics, weather events in the world, the actual earnings reporting of the company itself. All sorts of things happen that affect the share price. But if you look at the market, usually the long-term trend is upwards as a business grows. Predicting the stock market, if anybody tells you that they can predict the stock market over a short term or tell you what a stock is going to do, they are completely lying. You can have an educated guess, but the market will do whatever the market wants to do. There is sometimes no catalyst and no trigger at all for what causes a sell-off, and that is just part of investing. The longer you invest in a stock and the longer you invest in the market, it's essentially time in the market rather than time in the market, that actually mitigates the risk of this sort of thing happening. So you can essentially, with time, ride out any bumps, any jolts, any crashes in the market. Now, if you're looking for fair value in a company, lots of media outlets, lots of analyst sites are out there to work this out for you. You can easily work it out yourself by looking at the PE ratios and finding out what the fair value formula is and do it the hard way. Or you can look on places like Simply Wall Street, Seeking Alpha, at what fair value is. Now, this is what is essentially what the company is worth based on its earnings with respect to its share price. If the company's share price is over that and above fair value, then you are potentially overpaying for that company and should therefore not invest at this time. However, a lot of companies do not stick to that sort of rule. With regards to the likes of Tesla, for example, its PE ratio and its fair value side of things is completely skewed well off the chart, because everybody loves Tesla and knows that it's the future, and knows that they can make money out of it. So you pay a premium for investing in a company like that. The next stock market basic is be aware of trigger events. Now, such things can be minor or they can be huge, and it will depend whether it affects a sector of the market, the whole market, or just a few individual companies. Trigger events can be vast and they can be small. The global pandemic will be considered as a trigger event, as it collapsed the stock market in March last year, but then so can a earthquake in a country, if an earthquake, for example, hit New York near the stock exchange, then you can guarantee that that would have a knock-on effect on all the share prices in the market, despite the fact that it's not actually done any fundamental damage to any businesses listed on the stock market in that time. The age-old saying in the stock market is buy low and sell high. Everybody laughs at that, but that is essentially the point. You want to buy in at the lowest possible point and then sell at the highest possible point. But you can apply a little bit of common sense to this. So if you're trying to buy into a company at a low in the middle of a stock market crash, check the fundamentals of the company out first. If it checks out, buy in, and then just be patient. Hold that company for 6 months, for a year, however long it takes, and let the greed come back. So the best time to buy is when there's pessimism in the market or pessimism around the stock, and then you sell when people are at their most optimistic and when there's a lot of publicity at the stock, because the stock will be right at its highest point, and then you want to be selling off at around that point, lock in your profits, move on to something else if that's the sort of investing that you want. Long-term growth or long-term dividend investors have a massive advantage here, because for them it is pretty much about accumulating as many shares as they can get. So they're just going to buy in at the rock bottom prices and then just hold forever, essentially, especially if they've got some extremely high quality companies, and that is essentially what you are looking for. My take is exactly this. I'm a dividend investor and I'm a growth investor for the most part. I do have penny stocks and speculative plays. I enjoy that, but that roughly only makes up about 20% of my portfolio. And when you factor the dividend portfolio in as well, that amount of money goes down to about 5%. My main investing is dividend investing, growth investing. So for me, it's all about accumulating as many shares as I can for the best value as I can. Obviously, if there is fundamental changes to any of the companies that you've invested in, they have a PR disaster, they have a massive dip in their profits, or whatever it is, you need to obviously be monitoring all your companies that you're invested in for that. Then you may have to consider selling at that point. But for the most part, all of these companies that you've invested in, if you've done your research, you can just almost go to sleep on them and sit and hold them forever. And as a growth or dividend investor, that's exactly what you should be looking for. Thank you very much for watching today, guys. That concludes our Stock Market for Basics episode. It's been absolutely great to have you here. If you could consider liking the video on the way out and subscribing to my channel, that would be absolutely awesome. And I'll see you in another investing episode. Catch you later.